visionary, although he will tell you he's a cloner, Mohnish is a longtime value investor and CEO. He's an entrepreneur, an author, and a philanthropist. He regularly gives his time to meet with students to share his wisdom on investing, business, and life more broadly. Mohnish is the founder of the Pabrai investment funds and one of the most successful value investors in the world. He is an admirer and disciple of Warren Buffett and Charlie Munger, and famously paid just over $650,000 to have lunch with Warren Buffett back in 2007, which he later said was worth every penny. We'll get to this. Without further delay, let us extend a warm welcome to the man himself, Mr. Mohnish Pabrai. Please join me in giving him a virtual round of applause. Okay, so now back to DJ Khaled. DJ Khaled is famous for his song, All I Do Is Win. I know we'd all love to win all the time, but maybe that isn't realistic. Mohnish, you've taken a slightly different road, and you have this saying, heads I win, tails I don't lose much, that you've used in reference to your own style of investing in the stock market, your successful run at the casinos, and also the Patels, who started investing in motels in the 1970s or so. So Mohnish, what does heads I win, tails I don't lose mean to you? How did you come up with this framework? And how have you applied it in investing and other business dealings? In your response, feel free to address any or all of the examples I mentioned, including your experience in the stock market and casinos and or the Patels and motels.
Sure. Well, Charles, it's great to be here. And it was also wonderful to bump into you at the air train at JFK, which was kind of fun, short meeting there. Yeah, I think many times in life we are confronted with exactly these types of odds where if you go for something, it could be a winner and the downside is very limited, from taking a random meeting with a stranger to a variety of other things that you might engage with, I think Michael Jordan said, you miss all the shots that you don't take, so basically sometimes going for a few things, even if it's not a 100% sure bet, can work out really well in life. And I think one of the misnomers that people have about entrepreneurs is that they think entrepreneurs are risk takers. And actually, the reality is the complete opposite. So if I look at startups, and I would put startups into two different categories, venture-backed startups and non-venture-backed startups. Non-venture-backed startups make up 99.999% of all startups. And venture-backed startups actually are the anomaly. So I'm not talking about venture-backed startups. We can ignore those startups. But non-venture-backed startups basically tend to have entrepreneurs who tend to, even though they don't think about it in this format explicitly, they do everything in their power to minimize risk. And I gave the example in my book that, let's say there's a barber in a small town, and he has a barber shop and he's got customers, and he's kind of doing okay. But there's just about as many barbers as are needed in that town. So no one just does extraordinarily well, but everyone does okay. The barber notices that there's a new town emerging about 10 or 15 miles away. And he goes out there and he sees that, there's some growth happening, people moving in, etc. And that there are no barbershops in that place because it's brand new. And so what he does is he basically, sublets a small space, puts in a chair, and decides to spend 1 or 2 days a week, starts with 1 day a week at the emerging town. And because he's the only game in town, he can charge more for a haircut. And the opportunity cost for the people who live in that town is that they would have to travel 10 or 15 miles for another barber. And so they're willing to pay a little bit more just for the convenience. And so he goes out there once a week. And since he's the only game in town and hair grows and people need their follicle trims and so on, and business takes off. And he's doing better than average. He's making more in one day there than he does one day in the town with a lot of barbers. So he bumps that up to 2 days. Basically he starts spending more time there. And that is the way entrepreneurs go about it. So if you think about what is the risk that barber is taking by stepping into this new town? Well, he subleases some very small space. He probably buys some used equipment. He doesn't really have any payroll or anything. He's just going kind of himself. And, he might for a few days not have 100% load. So he might lose some business that he would have had in the other place. But the whole risk profile is extremely muted. It's very low. On the other hand, if this town booms, he could eventually be full-time in the new town. He might even be able to hire other barbers to work at his shop. And now he has, at least temporarily, supernormal profits. And so basically, this is kind of classically how a lot of entrepreneurs goes about it. This is the way the Patels went about. The Patels came to the US as refugees. They were thrown out of Uganda by Idi Amin. They had been there for 100 years, And so Idi Amin said that Africa is for Africans. These guys were Africans, basically. They weren't black, but they had been there for several generations. And they became stateless because he threw them out. And they dominated the Ugandan economy because of their, great approach to doing business. And the UK took some of them in as refugees. Canada took some of them. And the US took some of them. And they basically, all their assets were nationalized. So they lost almost everything. And they were able to convert a few of their assets into gold and get it out of the country. But when they came into the US, they didn't really have too many skills that would have been in high demand in the US. And the motel business looked very attractive because they could live in 1 or 2 rooms of a small motel. A bank would finance 70, 80, 90% of it. And they could employ the entire family into motels are labor intensive, into doing all the different, tasks needed for the motel, the housekeeping and front desk and so on. And what happened is the Patels basically accidentally didn't really set out to do this. They became low-cost providers because they had no workers' comp or payroll or anything. And because they were the low-cost provider in a particular area, they could look at what other motels were charging in the area and charge 10 or 15% less and still have the same profitability of everybody else. But when they charged 10 or 15% less, their occupancy went to nearly 100%. And so they had supernormal profits relative to the other motel owners. And this very small group of refugees that came in, I would say Patels in the US are in the tens of thousands today. They're not in the hundreds of thousands. Maybe they might be 100 or 200,000. But if you look at the US population of 330, 340 million, they're not even 1/10 of 1% of US population. Today, they own north of 50% of all motels in the country. When you're at a motel somewhere, you may not realize it, but you're at a Patel motel. And they've moved upscale into the Marriotts and the Hiltons and all of that. So so amongst the motels, the lower end motels, they have 50, 60% ownership. But even at the higher end ones, they're creeping up on the 15, 20, 25% of those. And it all worked just the way the barbershop worked, except in their case, what happened is, so entrepreneurs start off as arbitrage players. That's really what they're doing. They're arbitrage players. The barber is the classic example of an arbitrage player. And what happens is that over time in that new town, that barbershop's supernormal profits will not last. More barbers are going to come into that town. And eventually all those extra profits and higher prices that he charges usually will get eroded away. Now, what may happen, sometimes what happens in business is he's a talented barber and people get used to it. We are kind of creatures of habit and they like him. And if he's very talented, they might be willing to pay him 10, 15% more than anyone else, just because even though there are other barbers available, they now have a habit of coming to him and so on. So sometimes what should be a non-durable competitive advantage ends up becoming a competitive advantage by accident. And that's the same thing that happened with the Patels. What should have been a non-durable advantage actually became a sustaining advantage over a 50-year period. They just, took over that industry. And we see this over and over. So this heads I win, tails I don't lose much is actually the way almost all non-venture backed businesses get started. If you look at a small mom and pop Chinese restaurant that opens, they go through the exact same calculus. They look at, okay, I'm looking at Cambridge. Do they have an oversupply or undersupply of Chinese restaurants? Oh, there are too many Chinese restaurants in Cambridge. Let's forget about that idea. How about going, 70 miles away from Cambridge? What's the situation there? And there you might find a town with pathetic Chinese food, and these guys are talented chefs, and they might make it happen. And that, again, non-durable competitive advantage, if they're talented and they get a following, may become sustaining over time. And that's the way capitalism works. And that framework also is applicable in investing. I mean, the important thing in value investing, as practiced by Warren Buffett and Charlie Munger and so on, the very first thing is downside protection. We don't even look at upside until we first look at the downside. And it's just like the barber. The barber doesn't want to lose his shirt when he opens this new place. He's not going to go sign some fancy lease on some big space and put all his savings into that new thing. He's going to scrounge to keep the risk down. And if he does the fancy place with all the razzmatazz, he will be out of business really soon. And that'll be the end of the barber and all of that. So the entrepreneurs that make it, they are arbitrage players. They focus on the downside. And we as investors and value investors, we do the exact same thing. Whenever I'm looking at an investment, what we want is we're looking for free lunches. We want the downside to be zero or as close to zero as we can get with a massive upside. And because we function in auction-driven markets, and because auction-driven markets have a tendency to overshoot or undershoot, things get either too richly priced or too pathetically priced. The richly priced we can leave aside. Don't need to go buy Nokia. That's fine. I mean, sorry, don't need to buy Nvidia, but you can look at things which are hated and unloved. And there's always things that are hated and unloved. And when you get things that are hated and unloved, you can get mispricing in the right direction. And if 7 moons line up where once in a while some great business is hated and unloved for temporary reasons or some temporary issue, and then that can lead to a good result. So that's what we try to do.
Wonderful, wonderful. Thanks for breaking that down. And so I would like to backtrack a little here. So you were born and raised in India. You came to the US for college and studied engineering at Clemson. After graduating, like many of us, I think on the call, you went to work for a company for a few years, but in your mid-20s, you decided to start your own business. Can you tell us what that business was, what motivated you and gave you the courage to take the risk, if you even viewed it as risky to start the business, and how did your upbringing, anything I've touched on in terms of you growing up in India, studying in the US, or anything else, influence your decision to go off on your own relatively early to start your first business?
Yeah, so actually that business was actually my third business. the first business, which I was trying to do when I was about 22, about like a few months after I started working, I had some idea for some software tools, and I probably spent maybe $500 or $600, and it never went anywhere. And I put it to bed. And again, it was classically heads I win, tails I don't lose much, $500 down, we can handle that. And the second business, which I tried to get off the ground, was actually with two other good friends of mine. One of them was a very talented software programmer, and he had developed some tools, and we were going to try to see if we could market those and so on. And that one I probably spent maybe a couple of thousand and maybe about 6 months, part-time on the side, whatever. And that didn't go anywhere. And we put that to bed too. And again, it was easy to handle that too, no problem. And the third business, which I was by now about 25 years old, was one I decided to do on my own. And this one, basically, I was trying to get the business off the ground while I was working, because I'm like the barber guy. I'm like the barber shop, we're not taking any risk. We have like zero risk. And so for about 9 months, from the time I founded that company to the time I quit, I was basically working like 80 hours a week. So I was doing my job. And what I had decided to do for my third business was that, I always used to get great reviews and, was always focused on making sure I was a good employee and all that. So one of the changes I made in my mental model is that we're not interested in great reviews. We're not interested in being employee of the month or employee of the year or, top ranks or anything. We just want to make sure that I don't get fired. And I'm putting all my energy into the new business I'm getting off the ground. And the only thing I need the existing job to do is keep the paycheck coming. So I try to figure out how much I need to work and what kind of productivity I need to have so they do not fire me, because that would kibosh the plan pretty badly. And I think I calibrated it pretty well. And this third business, after about 9 months, I had 3 clients. There was significant revenue from each client. And I was just dying with so much work to do. And, I was kind of evenings, weekends, early morning. So I had enough cash flow coming out of this business that was more than what my paycheck was. So I went into my boss and I gave my resignation. And he said, "What are you going to do?" I said, I got this business off the ground, doesn't compete with the company I'm at or whatever. And I was, doing 2 things for 9 months. So I met with my boss and his boss, and they said to me, Mohnish, we really were puzzled what happened to you in the last few months, because we saw such a big drop off in the Mohnish we knew. And he said, we had several discussions about what's going on, and we discussed whether you should be fired. And the conclusion we came to was that it's not so bad that he needs to be fired. I said, exactly. I was trying to calibrate, so I kept above firing level, just slightly above, just my neck above water. He said, you hit it so well, because we never got to the point where it dropped so much. I said, man, this was beautiful. And so anyway, both of them stayed, they're still good friends. And after about 10 years, they both invested in Pabrai funds, and they're investors with me and so on. So it's been a relationship for a long time. So the third business got traction. That was a IT consulting system integration business. And basically it was the same thing as a barbershop, Instead of like opening a barbershop 10 miles out, I was just doing 2 jobs at the same time. Someone's paying the paycheck, someone's paying the rent, doing all of that. And there's no downside. And the first business, $500 gone, no problem. Second business, $2,000 gone, no problem. The third business, I took $30,000 out of my 401k. I was 25 years old. I wasn't concerned about retirement. I said, we can deal with retirement later. And then I took every credit card that would, give me an offer. So I had about 70,000 in unused credit cards with me. And then one by one, because the business needed a lot of cash for cash flow, I maxed out all my credit cards. So basically, eventually 100,000 went into that business, but it was already profitable. It had clients, customers. And eventually, I sold that business and then went into the investing business. But everything I've done in my career, I only had one employer, has always been the minimization of risk. And anytime I've done ventures where I've decided to, do something very professionally with proper resources, etc., those have all failed. It has only been these, scroungy, crappy startups which don't take any capital that have really worked. And so that's been the journey so far.
Okay, so first business didn't go so well, but that's okay. Tails, you didn't lose much. Second business, same thing. Third business comes around, you're in your mid-20s, you start this one, you have some traction. I believe a few years pass by, you're now in your early 30s. It's the year 2000, and you sold that business for 20 million. I think you netted about 1 million personally in today's dollars, adjusted for inflation. I think that's about 1.8 million. I'm curious.
No. The business sold. I mean, we were doing about 20 million in revenue. It sold for a lot more than that.
A lot more. Okay. But
you're quoting my return numbers.
In terms of netting the profit, I think it was a significant amount personally.
Yeah. So actually, what happened is that in 90, I sold that business in 2000. I actually stopped working there in 99. I actually lost interest in the business, and I got a lot more interested in investing and Buffett and Berkshire. So what I had done with that business is in 94, I had sold a portion of that company, a small portion of the business. And after taxes, I got about $1 million. So I still own the business, but I just sold one small piece of it. And that million, I started investing in the equity markets using Buffett's approach. And that million over the next 5 or 6 years became about 13 million. Well done, Mohnish, And that was like 70% annualized rate of return or something. And I got more and more interested in the investing side, less and less interested in being like a CEO and managing. I mean, the business I was running had close to 200 people at that time. So it was very kind of operationally intensive. And I just like to lead a, laid back life. And life was not laid back, it was pretty intense. So what I did in 99 was I did two things. One is I applied to Warren Buffett for a job because I decided, I was thinking, well, what do I want to do next? I said, what I want to do is want to go work for Warren Buffett. That'd be great. And I already had enough money where I didn't feel like I needed to work anymore. So I said, now I can, do whatever I want. And Buffett said, thanks, no thanks, I work alone. And so then my friends told me to start a fund like the Buffett Partnerships, which is what I did in 99. And then I basically hired a CEO to run the business. And then about 6 weeks after he came on board to run it, he moved from EDS in Dallas. He called me and said, someone wants to buy the business. Now, I had done a deal with him where he's going to have, all these kind of, incentives if he grows the business, whatever else. And so I said, look, I don't want to really pull the rug out from under you. What do you think we should do? So he says, sell the business. So all of his options and everything that he had vested immediately upon change of control. So for 6 weeks of work, he was going to get paid a lot of money. And the new people who were buying the company, they were not looking at me because I had already left. They wanted to lock him up to run the business. And so they gave him a new deal with a new package. So he said, please sell the business so I can ring the register once and then work on ringing the register the second time. And I was happy because I had no interest in the business anymore. So everyone worked out great for everyone. And then I started focusing on Pabrai funds, and we started with $1 million from 8 investors, and we grew that over the years, and it's worked out okay.
Can you talk a little bit more about this? And thank you for the clarifications there. Can you talk a little bit more about the transition from running that business to getting into investing, following the Buffett framework? I think in the near future, if not already, many people on this call will find themselves with sizable amount of cash and will want to and need to do something with it. So I'm curious, what advice do you have for us, and how did you choose how to actually go invest that money that you earned?
Well, I mean, I think the investing the money was a easy thing for me to do because I had been studying Buffett's approach to investing for a while. It had been about 5 or 6 years. I'd been studying it. I'd applied it. I had done very well with it. And so I just had a very simple approach, which was what I would call a 10 by 10 portfolio. So I was only making investments in the public markets. If I made an investment, it was typically 1/10 of assets. And basically, when I was fully invested, I'd have like 10 stocks. And that was it. And then basically wait for them to, reach intrinsic value. Sometimes you make a mistake, many times you make a mistake. And the investing business is very forgiving. Even if you're wrong half the time, you'll still do really well. And so basically, I knew that I could invest well. And so then I never really planned to be in the investment business. What happened in 99 was that a few friends of mine came to me. So I used to give my friends stock tips from like 94 to 99. I'd buy some company. And after I'm loaded up, I'd tell my friends, hey, I researched this business and it looks good. And if you want to, you can feel free to invest in it, place and trade on E-Trade or whatever you want. And, no reps and guarantees or anything, but you can do whatever you want. And many of them would take my tips and invest, and they did really well. And so they came to me as a group in 99, and they said that we would like you to manage some money for us because this is too random. You give us a stock tip, then we don't see you for a while, and then we don't know what to do and whatever. And so basically, Pabrai funds really started as a hobby between me and 8 friends. And they gave me collectively about $1 million. I put 100,000 in. And, now I manage around 900 million or so. And so I actually just thought of it as a hobby at that time in 99. Then in 2000, the first year, we started in July 99. By June of 2000, we were up like 70%. And the NASDAQ had crashed. Everything had crashed. And nothing had happened to us. And nothing had happened to us because I was buying funeral homes. When everyone else was buying pets.com, I was buying funeral homes at 2 times earnings. And I was buying steel company, coal company, and whatever that people didn't have an interest in. And everyone else was interested in, all these high-flying internet stocks that eventually went to zero. And so, in fact, the markets were a difficult place to be from 2000 onwards because they were so overheated. Coke was trading at 50 times earnings. Microsoft was at a $600 or $700 billion market cap. It did not see that market cap again for 10 or 11 years. So if you invested in Microsoft in 2000, you had seriously negative results for the next 10, 12 years. And of course, I had no interest in investing in Microsoft. I was just looking at very basic businesses at that time. So I changed my investing style. In the 90s, I was doing a lot of tech investing because it was not overheated and I understood the space well. In the 2000s, early 2000s, I switched to hardcore Ben Graham deep value. And because that was the only thing that made sense. I could never make sense of investing in Microsoft or something at that time. And so it worked out just fine, no problems.
Got it. And I imagine through that time, as you were studying some of these investors, you were picking up their principles and philosophies. I've heard you mention that this wasn't really the common trend during that time. And so it's made me wonder how you could have the best investor in the world sitting in Omaha, openly sharing his investment philosophy and approach, and virtually no one follows it. And in fact, I think in many cases, they go ahead and they do the exact opposite. I'd guess that Mr. Buffett doesn't analyze companies using Excel. You have your investing 10 commandments, and one rule is thou shall not use Excel. I think in your book, Dondo Investor, you've also demonstrated by, instead of using Excel, a valuation of Bed Bath & Beyond using a Texas Instruments calculator, and you ran a DCF, a discounted cash flow model, and you came up with a valuation for Bed Bath & Beyond. I'm wondering, how should we think about and reconcile this? On the one hand, as business school students, a lot of us here sit through finance classes and develop models in Excel. But your view, correct me if I'm wrong, is that if the investment requires you to fire up Excel, you take an automatic pass on it. So again, how should we think about this and reconcile that?
I'm so sorry to break it to you, Charles, but they wasted your time. They have filled your head with mush. You need to reprogram. You need to detox. You need to go into rehab and then come out the other side with no need for Excel ever again. And life will be great. So one of the things I've found, which is the quirk about humans, that I know the quirk exists. I'm not exactly sure why it exists. And I've tried to understand why it exists. I still haven't figured it out. So for whatever reason, humans have an aversion to cloning. You said, I'm a cloner. I'm not a cloner. I'm a shameless cloner. So let's not miss the full thing. The cloner just doesn't do justice. Shameless cloner. So I remember when I first met Warren and Charlie, and they were asking me. So I had replicated the rules of the Buffett partnerships, which I thought were really good rules. And I told Charlie, I said, look, Warren ran these partnerships from 1956 to 1969. They had the best record of any investment partnership. Even probably till today, there might be very, very few that have done better than that. And he had an approach to doing that made all the sense in the world. He never charged any management fees. He took 1/4 of the upside over 6%. And I replicated all those rules. So I told Charlie that, look, the Buffett partnerships ended in 1969. The Indian guy in front of you starts the Pabrai funds in 1999, 30 years later. I said I looked high and low for anyone who had replicated that model in the last 30 years. And all I could find was nobody, zero. And I realized, just like so many other things that people are not willing to clone, that when you find something that's a great idea, what you will repeatedly find is nobody else is interested. And I just really don't understand why this is the case. If I look at a business like Chipotle, Chipotle is a fantastic business. I actually wrote about it in my first book. Okay. And I wrote about how amazing the business is. From then till today, what is so difficult about Chipotle? Nothing. Okay. If you're a talented chef, you could clone every single aspect of Chipotle. Okay. Nobody has done that. Okay. Now we've had some players come in like Kava and a few others in other fields, but they came after a long time. And no one thought that I should do a burrito or do a taco in a format where the user controls what goes in it. Okay, that was the thing they changed. You don't order the taco and tell them, give me this and that. You actually direct each ingredient going in, which is what makes it unique, because you can make it exactly what you want, right? It's not rocket science. But just like no one replicated the Buffett partnerships, there's a gazillion things around us, which are terrific businesses and terrific ideas. They could be 5 of those, and no one's interested. This is the nature of humans. So there is a lot of opportunity in a lot of different fields because humans are not interested. So I told Charlie, listen, 30 years, the Indian guy had to finally come along and do this. So Charlie said, well, Mohnish, there were a couple of guys who cloned our model. I said, yeah, but Charlie, I didn't know about them. He said, no, they were very obscure. You would have never heard of them. And you are absolutely right that 99.9999% of humans have no interest in what we were doing. And now when I look at Buffett's approach to investing, there are very, very few business schools. Columbia, University of Florida, Missouri, Jack McDonald at Stanford. You notice I skipped Harvard. Okay. It's a place with a lot of intelligent life, but no strong value investing program. Doesn't exist. Bizarre, you know? So, but it's the way it is. And if I look at the other, 100 other business schools in the US, no program. And that's because, the capital asset pricing model and a zillion other things, efficient market theories, these are beautiful things to play around in Excel. And they have nothing to do with reality and nothing to do with the way the world really works. And so, what would actually be a way to make a lot of money is not taught in these schools. It's just taught in very, very few places. And you actually don't need to go to any school. You can just, Buffett.cnbc.com has all the annual meetings for the last more than 25 years, 6 hours each. So it's about 150 hours of Warren and Charlie. So I went through every single one of those in the shower twice. It took about 6-7 months while I'm showering and shaving and brushing every morning. And I'm going through it right now for the third time. Each time I learn more. And every morning I get educated, and it's right now I'm in the year 2001, the afternoon session. It's an orgasmic experience. And the thing is, it's all there. It's free. Then you have all the Berkshire letters and you have all the transcripts. I mean, you really don't need to spend even $5. It's all there. Don't need to pay tuition to nobody. But no one's interested. It's all there, but no one's interested. So I just said, okay, the Buffett partnership structure, no one's interested. I'll clone it. Buffett's approach to investing, no one's interested. I'll do that too. And even today, some people follow value investing. It's still a very small sliver. So we continue to find inefficiencies in the markets. We continue to find widely mispriced great businesses. And, there's $100 bill on the ground. There's two University of Chicago economists walking by. They see the $100 bill. And the one guy says, oh, look, there's a $100 bill. The other guy says, they're both efficient market theorists. He said, it's not there. If it was there, it would have been gone a long time ago. It's not there. Keep walking. Okay, that's the way the world works. The $100 bill that they can see is not there. Okay, and so the Indian guy is going to go in and pick up the stupid $100 bill that no one else wants to see. And it's okay. That's what we do. We just go pick up the $100 bills lying around.
Wow. So $5 for this Buffett education, and here I am paying a couple thousand, noted. I'll probably have to wait until after the semester, but once I'm done with my classes, I'll scrub my mind of Excel.
Maybe you should ask for a refund.
I don't know if that'll work out. But I think another thing is this idea and power behind diversification. And I personally see some benefits to it. And we learned quite a bit about it in our first year, but I can also appreciate one consolidating their efforts and investment on a few select opportunities. You've said to make few bets, big bets, infrequent bets, particularly when there's little risk and high uncertainty. Can you talk more about your view on diversification? I know Charlie Munger refers to it as diversification, and perhaps you can even highlight how your perspective on diversification has influenced your investments at Pabrai Funds.
Well, the thing is, if we go back to the 99.99% of startups that are not venture-backed, and some of them succeed, like my company, my third startup succeeded. For a long period of time, more than 90%, 95% of my net worth was in one company. And that's not unusual. The couple that owns the Chinese restaurant, they got 90% of assets in one company. And the barber shop, most of it is one company. Okay, they're not diversified. Not only are they not diversified, it's not liquid. Okay, they can't trade it, they can't monetize it, they can't do anything with it. And they are very happy with all of that. You don't see them breaking out in hives about the fact that, oh my God, I only have everything in one business. So when control is overrated, saying that if I have everything in one business, just because I control it, I should be okay. I mean, that's a flawed approach. So in the stock market, we have the option, the option of not having it all in one business, right? But once you get past 5, 6, 7, maybe 10 businesses, after that you start hurting yourself because you're not going to know the 11th business as well as your second business. And why buy more of the 11th business when you know the second best business you love so well, right? And so, a few years back, I started investing in Turkey, right? And no one's interested in Turkey. In fact, when I was investing, everyone was exiting. All the foreign investors had left. Everyone left. And the local Turkish investors, they're all gamblers. So if you look at the Turkish stock market, which has 200 or 300 listed companies, and you exclude the stake owned by the promoters, the founders of the businesses, the float is cycling every 9 days. So if some company has 70% float of their stock, it's changing hands completely every 9 days. Every 9 days is a new set of shareholders. Now, Buffett has a quote. Stock market is a mechanism to transfer wealth from the active to the inactive. I looked at Turkey and I said, this is beautiful. I'm playing poker with people who want to be blindfolded. And if you want to be blindfolded and playing poker, no problem. I'll play poker with you. And so when I went into Turkey, there was so much fear. Everyone exited. We today own 3 businesses in Turkey. Okay. One is a warehouse operator. So the warehouse operator, just to tell you about the $100 bill on the floor that no one wants to pick up. So this company, the day I went to meet them in 2019, the market cap was 16 million US dollars, 16. The liquidation value of the business was about 800 million, 800, 2% of liquidation value. And the liquidation value would take about 20 minutes to figure out because they got a bunch of warehouses rented out to Amazon, IKEA, Carrefour, Mercedes, Toyota, DuPont, on and on, all these, multinationals, 99% lease, 10-year leases, inflation index that you could flip and be done. So those warehouses worth about $1 billion. There was 200 million of debt. You would net about 800 million. And there were cash flows coming out of those rents and the market cap was 16 million. And then I thought, it's going to be illiquid. What am I going to get? For $8 million, I got 1/3 of the company. Okay. Now, fast forward to 23. When I was investing, the Turkish lira was 5 lira to the dollar. Now it's 28 lira to the dollar. It's collapsed. Okay. In dollars, the market cap is over 700 million. In dollars. In lira, my return is infinite. But who cares about that? And the business is now worth about $1.5 billion. I mean, they've increased the value of the business over the years. So the dollar bill was just sitting on the ground and no one was interested. And I remember Templeton Funds, who was in a hurry to get out of Turkey. They sold me a block, 5% block of that company. I own 1/3 of the company, but 5% block of that company for $1 million. $1 million for 5% of that company, which is today worth $1.5 billion. So it'll be about 75 million. So it'll be about a 1/75th of the current value is what some guy in New York decided he wanted to sell that for. That's fine, no problem. And then we own a Coke bottler in Turkey. And Coke bottling is a great business. And we own an airport operator. All 3 assets were widely mispriced. There were $100 bills sitting on the ground. And so, what I do is I just spend all my time talking to students like Charles And then every once in a while, we find some $100 bill on the ground. We go do some work, we pick up the $100 bill, then come back to talking to the students again. And that's my life.
Oh,
Thank
okay.
you, Warren.
So yeah, and speaking of Warren, I'd like to go there actually. So just shuffling a little bit back to 2007. So you put into practice Buffett's rules of investing. You're simultaneously developing your own complementary investment philosophy, and you're outperforming the market. As you would say, life is good. And then at that point, I think it gets even better for you. You get the opportunity to bid for a charity lunch with Warren Buffett. You invite your friend Guy Spear to join you, and together you pay over $650,000 to win the auction with Buffett. Now, I remember within the first few months or so at business school, a professor of mine took the time to tell my class that as we go through this business school journey, we should make sure that we're developing relationships that aren't just transactional. The opposite of a transactional relationship is a relational relationship, which emphasizes building trust, mutual understanding, and a long-term connection without an immediate expectation of receiving something in return. So do you feel that this opportunity you had to have lunch and interact with Buffett was transactional, or was that relational? And how and why did you intentionally cultivate one over the other? And finally, what unforeseeable benefits did that lead to?
Well, it led to all kinds of great things, which I never imagined. So I didn't do so much business school thinking about the lunch. Okay, all I did was the Indian guy comes to the US as a foreign student. He finds this guy in Omaha. He reads up on him, makes some money, and in 2007 he finds he's worth $85 million. And most of it is coming from plagiarizing everything Buffett's done. So, cloning the hell out of him. And I'm just saying, there's a tuition bill due here. Even though he didn't charge me, there's a tuition bill due. And then I see that the guy takes bribes to have lunches once a year, So I said, we're going to pay the bribe. We're going to have the lunch. And then I thought about, what should be the tuition bill for something that makes you, 70, 80 million or something. And I said, how about $2 million? I said, 2 million done, 3% something, it's pretty cheap deal, if you give 3% for what you get. So I told my friend Guy Spear, because we're allowed to bring like 7 people to the lunch, right? So I told my friend Guy Spear, listen, I want to bid for this lunch. I didn't know him very well then. And he was the only guy I approached. And I said, do you want to come in with me on this? He said, yeah, my wife and I would love to attend. So I said, look, there'll be 4 of us because I was going to go with my kids. And there'll be 2 of you. So you pay 1/3, I'll pay 2/3. Okay. And I said, look, I'm going to bid up to 2 million. So he said, whoa, wait. I can't do 650, whatever, thousand. It's too rich for me. So I said, how much can you do? He said, I'm good for $250,000. I said, okay, no problem. You're capped at $250,000. No matter what the bidding goes crazy at, you have 2 slots at the lunch for $250,000. And so he said, okay. And so I was still willing to bid 2 million. Nobody else wanted to bid more than 650,000. So I won it for 650,100, Even what I wanted to spend on that lunch, I couldn't do. So such is life. And then, my only agenda item when I met Warren was to look him in the eye and just say thank you. I had no other agenda item. Now the lunch goes for like 2-3 hours. You can ask all kinds of questions. I wrote down a bunch of questions. My kids were asking questions. Guy was asking questions. So we had a ball, And when Buffett came for the lunch, we had the lunch in New York City. He said, look, I got nothing going on all afternoon. So when you guys get sick and tired of me, you let me know, I'll leave. But I don't have to be anywhere till like 7 p.m. So I'm here for as long as you want me to be here. Okay. And so basically, and I never expected that the lunch would lead to anything, right? I mean, I was just, I told Warren that I want to thank you. I learned so much from you. I plagiarized you. I cloned your model and all of this without asking your permission. So I'm so sorry, but thank you so much. And then, he introduced us to Charlie Munger. So I met Charlie with my wife, and I actually enjoyed the lunch with Charlie a lot more than Warren. That was so much fun. And then that led to a friendship with Charlie, and then a friendship with Warren. So that lunch became like, Buffett used to have a brunch every Sunday at the Berkshire meeting for his like directors, all the CEOs of all his companies, his friends. And he would invite Guy and me to that brunch. That's like all A-listers. So Guy and I would go to that lunch, and I would tell Guy, listen, Guy, don't turn around, but right behind us, Bill Gates and Bono are having a conversation. Okay. And maybe we'll go get some pictures with them a little later. But I met so many NFL players there. I met, Hollywood stars there. Bill Gates would always show up. And then all these, Bono and whatever musicians, whatever else is going on, and a bunch of celebrity CEOs and whatnot. So, every year I tell Guy, next year we're going to be off the list. We're the only two yo-yos here. Everyone else is somebody except us, but we keep getting the invite. And so I had no agenda for that lunch. I just wanted to, say thank you, pay a 2-3% tuition bill. I didn't even pay 1%. It was a very cheap deal. And then most recently, that lunch went for, I think 19 million, the last one they did. So, and now there are no more lunches. He stopped taking bribes. So such is life.
Wow, that's great. So you've managed to outperform the market. You've generated all this wealth for yourself and others who have invested in your fund. You've met the guru of all gurus in the investing world, Warren Buffett, and managed to form a close relationship with his business partner, Charlie Munger. And now you have to decide what else you want to do with your life and what to do with all the money that you've accumulated. I think around this time in 2007, you also started the Dakshana Foundation. As I mentioned earlier in the intro, it's an extraordinary organization that has had unique success and has helped to lift thousands of families out of poverty. But don't take my word for it. I have here a copy of a letter from Warren Buffett, which he wrote to you. And it's a copy of the letter. And this letter reads, if I can pull it up here. I know it's here somewhere. Okay. He says, "Dear Mohnish, I remain incredibly impressed by what you have done, are doing, and will do at Dakshana. It is simply terrific, far more impressive than what business titans, investment gurus, and famous politicians have ever accomplished. I'm glad my annual report doesn't get compared to the Dakshana annual report. It's an honor to even be quoted in it. With admiration, Warren E. Buffett." So, Warren Buffett is known for his annual reports, and he says he doesn't want it to be compared to Dakshana's annual report. How has Dakshana managed to accomplish what it has for its students and families? What advice do you have for us about how we should think about social impact, philanthropy, and finding meaning in the work that we do?
Well, first of all, we should not believe everything Mr. Buffett says or writes. So I think he's being very modest. He was very generous with the letter he wrote. Made my day, made my year, made my life, it was great. But obviously his annual reports are the gold standard. I cloned his annual report. That's why he likes my annual report. We don't put any pictures in our annual report, just like his annual report. I use the same font that he uses. So I think he likes it because of all those reasons. But anyway, so the thing is, at the core, what Mohnish is a game player. Okay, I like to play games. Blackjack, bridge, investing, philanthropy, it's all games. Okay, but I don't just like to play games. Some psychologists who got into my head to figure out who I am, they said to me, Mohnish, this is what they said to me exactly. They said, Mohnish, we cracked your head open. We know exactly what's going on. They said to me, you like to play games. I said, that's right. I like to play games. He said, but not just any kind of games. You like to play games where you think you can win. I said, yeah, who wants to play games that you're going to lose at? He said, no, a lot of people play a lot of different games, but you like to play games that you know that you have some edge that you can win. So basically, I'm playing, one of the games I'm playing is there's a compounding game that's going on. We go to Turkey, we pick up some dollar bills, we buy some coal companies in the US that nobody wants to touch, whatever else, we do okay. So this compounding engine builds wealth. Now, I have no ability to spend this wealth. Nothing that I would do with this money would increase happiness or anything. I live the life, I have the lifestyle that I want, and I don't need to go beyond that, right? So there is going to be hopefully significant amounts left over. Now, what I want to have happen, so June 11th, 2054, June 11th, 2054 is the day I am leaving planet Earth. Okay. And so one day before that, which is June 10th, 2054, my net worth needs to be down to $100. Maybe $1,000 so the funeral gets taken care of. Okay. But basically, my net worth needs to be down to a few $1,000s at the most. Done. So we have an engine that is growing wealth. There needed to be another engine that takes that wealth down. And so there are two games going on: the wealth accumulation game and the wealth disbursement game. Now, because I'm a game player, I want to play the games well. So if we're going to give the money away, we're not going to do some nonsense. We're not going to just randomly pick some, nonprofit charity, whatever. We want to find the best charity. So first, what I tried to do is I looked for organizations that impressed me in terms of how they went about doing social good. And I was looking at this in 2005, 2006. And actually what I came up with was deep disappointment. I could not find even one nonprofit that impressed me with doing things the way I thought they should be done, which is that when we are giving money away, we have to look at social return on invested capital. We have to look at what we put in and what is the output. And we have to measure that output. So if I give a charity $1,000, I want to know what happened to the $1,000. What did it do? What benefit did it create? The problem with giving money away is measurements are really hard, very, very hard. Even most charities are run by well-meaning people, but they've not even thought about measuring because it's so hard to do. So what I did is I used Charlie Munger's principle, which is the inversion principle. He says, invert, always invert. So what I said is, okay, the only causes I'm going to look at are causes where measurements are easy. So we have, we could go into environmental, healthcare, homelessness, education, poverty, whatever. There's 100 different causes you could go focus on. I said, I'm going to focus on the ones where we can measure outcomes easily. And one of the things that happens in education, when you focus on education, is there's a report card and you can measure those outcomes. Like the Gates Foundation thought that if you reduce class size, you would get better outcomes. And they put a lot of money behind it. And they later discovered that reducing class size actually didn't have the outcome. So they gave up on that. But they measured it and they found that it didn't work. So they went and did something else. So in our case, we said, okay, if we prep these kids for the IIT entrance exam in India, basically the interesting thing about the IITs and the medical schools in India is if you get in, they're basically free to attend. And if you get in, Microsoft will hire you, Amazon will hire you, Google will hire you, because that's where they go to recruit. So, but getting in is really hard. And the prep to get in India now costs like $5,000-$6,000. I'm dealing with families with around $1 or $2 a day for the whole family to live on. So you got a family making $300 a year or $600 a year. How are they going to spend $5,000 on prep for a test where 1.3% are successful? So you're not going to spend 5,000 or 1.3% short, even if you had the money. You need to have $100,000 to put the 5,000 at stake. So the only people who are able to afford, and without professional prep for these schools, I mean, the IITs have 2 million kids, 2 million kids applying for 13,000 seats. Okay, it's a 1.3% admit rate. It's really hard. So what we were able to do is we created an engine to find raw talent amongst really poor kids in rural India, wherever. And then we reset everything. We brought them into a campus. We, room, board, faculty, everything. We have 7 campuses in India. One of them, the largest one, is 109 acres. And we basically give them, it's a better facility than any of the for-profit prep places. Because, we didn't build it to make money. We built it to give the best thing. And it worked. So, and we were able to take these kids who many of them wouldn't have gone to college, whatever else. And now many of them are in the US, they're working at all these multinationals, whatever else. And we get a report card every year. And my team cannot manipulate the report card because it's the IIT entrance results. No one can manipulate that. Basically, it is what it is. It's what the test result is. And it's an independent third-party test result. So I said, okay, we got measurements. And now we've been doing this for like 16 years or so. So every year when we get the results, we look at the results, we look at what can we change, and we tweak the model. We make kind of fine-tune, okay, we spend more time on thermodynamics, we will get this result. And if we spend less time on organic chemistry, we kind of tweak things around, whatever else, to optimize things. And we just keep doing that, and it works. So, and I think Warren appreciates all of this because and it worked out way better than I thought. This was all like a, academic pipe dream. I expected to fail on this. I have no expertise in any of this when we started. I still don't have expertise. And I just ended up with a great team in India, which made this happen. So it worked, and it kind of worked in spite of all the odds. And now we have so many of our alums who work for us. So eventually, Dakshana will be completely run by our own alums. They'll be run by them, managed by them. They'll do everything. And it's great. It's worked out great. So, but the game is still, one engine creating the wealth, one engine giving it away. And I still have to figure out, because if the wealth building engine compounds, and 2054 is 31 years away. And if I can compound at a good, healthy rate, that's a good amount of money. Even if I compound it, for example, at, let's say, 10% a year, I mean, rule of 72, every 7 years it would double. That'd be like 4 or 5 doubles. Okay. So 5 doubles is 15x. Okay. 2, 4, 8, 16, 32, 32x is 32x. So whatever I have would be 32 times in that period. And I'd have to give away the whole 32 times. And so we have to keep figuring out ways to give away the money, but we need to do it in an optimal way. So, I play bridge, I play blackjack, I play investing, and I play philanthropy. These are the 4 games I play. That's it. A little bit of tennis, a little bit of pickleball, a little bit of golf, and that's it.
The last 3 I'm trying to pick up myself. I'll circle very soon to what you said about 2054. But before we get there, I just wanted to say, so I met you in person for the first time. It was in May 2022 at the Berkshire annual meeting in Omaha. I visited your office in Austin in August 2022 and met some members on your staff. And then this summer on a train ride to JFK, you addressed this in the beginning, you and I randomly, it was totally random, sat next to each other on the train. And as you could tell, I was very surprised to see you there. And in your classic way, you said to me, in only the way you could, the universe conspires to help us. So what did you mean by this? And do you actually believe this? And in what sense? Is there a higher power? And what can we do as humans to maybe get in sync with the universe or that higher power and help it conspire to help us even more?
Yeah, I mean, I think that, many of the things I notice in my life, they turn out magically. And they shouldn't really turn out magically. They should be really hard. I mean, Dakshana is a good example. I mean, India is a very difficult place to do things, and we should have failed. In fact, I expected to fail. And it worked. And I think it worked because there was a purity of purpose. So the team that came, they are more passionate about it than I am because it's such a pure purpose. And I think when you have this purity of purpose, the universe does conspire to help you. It just is, it's hard to explain, but I think that the important thing in life is be a good person, focus on some core principles, which are good principles, some good mental models. And then after that, I think what happens is that just naturally great things happen. There's a book written by Adam Grant, Give and Take. He says there are three kinds of people in the world: the givers, the takers, and the matchers. So the matchers are people like, oh, someone did me a favor, I'm going to do a similar favor for them. They kind of match things in life. The takers, who you want to have nothing to do with, are extractors, the used car salesman, all of that. So you don't want takers in your life. And then the givers are the ones who basically are doing things for you without any expectation of anything coming back to them. And what Adam Grant pointed out in his book is that the givers are trying to give things. But what ends up happening is they get 10x more. Then it's like the Buffett lunch, right? The Buffett lunch, there was no agenda. It was just a thank you, Warren, you've been so good, right? So much came back from it that I never wanted, thought, expected, none of that, right? And this happens repeatedly. So what you want to do in life is you want to be a giver. You want to make sure that there are no matchers or takers in your life. Eliminate them. Now, this is really hard for most humans. So you have some friend who is a matcher, decent person, whatever. They need to be wiped out. And that's hard for humans. But that's the path you need to be on. So you need to have only givers around you. And so when you do that, when there's only givers around you, it just becomes a different kind of life, very different kind of life. When I used to play bridge with Charlie Munger when he was going to his club every Friday, probably 2-3 times a month. And I got to know Charlie's friends. I played bridge with them and I got to know them. And it struck me that these were some of the highest quality people I had ever met in my life. I mean, Charlie had collected a set of people that were unbelievably high quality. So I said, you know what? I'm never going to be able to find people like this on my own. Mm-hmm. So you know what I'm going to do? I'm going to go one step beyond cloning. I'm just going to make these guys my friends. And that's what I did. I worked on making them my friends because I knew I could not find better people than them. Okay. All of them are givers. Okay. And so we have to be harsh graders with who we spend time with. We become who we spend time with. And so we have to focus on spending time with people who are the highest quality people that we can find, who will have us as their friends. And after that, it becomes so magical.
Well summarized. And so last one in terms of this portion for me, but Warren Buffett recently turned 93 years old, and his partner, Charlie Munger, will turn 100 years old on January 1st, I believe. You've said that you have until, I think, 2054 left. I hope that you clone the age aspect of both Warren and Charlie, and you live much longer than that. But in any case, what's next for you? How do you even approach maximizing the time that you have left? In other words, what's your framework for discovering what matters most to you? And then in a world full of noise, really focusing on those things and doing them exceptionally well.
No, I mean, actually, I don't try to approach it that way. I told you, I approach it from the point of view of a game player, and I want to have fun at all the games I play. So investing has to be fun. Dakshana has to be fun. bridge has to be fun. And if we are doing things that are fun, we will do them well. We'll enjoy them, we'll do them well. So I don't really have any big plan. I have no idea where the next investment idea will come from. It's a very opportunistic thing. I don't know where Dakshana will be in 5 years. I have no idea. Many things. So there's really no kind of blueprint or plan. It's just that there's a high level idea that we want to, end up at zero. And, so that's kind of there's a guy, I think I'm forgetting the name, there's a book called The Billionaire Who Wasn't, his name will come to me. But anyway, he succeeded in doing that. He created a bunch of businesses, made billions. And actually now he just has a rented condo in San Francisco and a very basic, lives on $5,000-$6,000 a month, and everything's gone. He's like in his 80s or whatever. And so he was very successful at doing that. And so that's the model. But I don't really have much more than that kind of laid out.
All right. All right. So that's sort of it on my portion. I did want to maybe open it up to the audience and see if we can get a few questions in from the audience. So if anyone does have a question, again, you can go ahead and raise your hand. Please state your name, what school or what your occupation is, and come off mute, and we'd love to hear from you. I think the first one is Tracy Dixon. We'll go ahead and take.
Hi, my name is Tracy. I'm at the Harvard Graduate School of Education in the Online Education Leadership Program. It is a pleasure to hear you speak. I had a question about, I'm a music teacher. I teach violin, and I'm making a shift. I don't know what I'm doing. I'm 49 years old, so a bit mixed up. But my question is about like strategy with stocks. I come from humble beginnings, and I've been investing since like the early 90s, but like I didn't know what I was doing. And now I have some money, and I keep, as I try to keep buying bits of the Berkshire B-class stocks, because that's what I can afford. And in my mind, my strategy is to continue chipping until I can get to that next spot. So I just wanted to know, is that a strategy, or I'm constantly learning?
Actually, Tracy, that's a very good strategy. I think the Berkshire Bs are great. The only possible change I would make is I would maybe do 50% Berkshire B and 50% S&P 500. And I would not like sell your Berkshire Bs to go into the S&P. What I would do is, if you have a certain allocation to Berkshire Bs in the future, I would move the future savings as they come in into the S&P. So that way you would end up with two vehicles, and I think that it's hard for me to predict which of the two does better. Even I think Warren and Charlie may have a difficult time figuring that out. But it just gives you a little bit more diversification than, even though Berkshire itself is quite diversified. But I think the Berkshire B is a good way to go, and maybe just add the S&P on top of it and you're done. And you can get a low-cost ETF, very low frictional costs on the S&P 500 at Vanguard or one of those places. So the cost is low, and so that can work well.
Thank you very, very, very much.
And I think in the interest of time, we'll take these three more that are up there. So Johnson, I see you next if you want to come off mute.
Hi, Mohnish. My name's Johnson. I'm a senior researcher here at Harvard. I'm a big fan of yours. I've been following you for a long time, and I've read both your books, which I think are both great for aspiring investors. My question is, why did Buffett? I never quite understood this. Why did Buffett close his partnership? He had this great engine. He was generating great returns. You cloned it 30 years later. Why did he shut it down? Why didn't he continue with it?
Yeah, so I think the reason he shut it down, he made the decision to shut it down in late 69. He actually ended it in 1970, was because the markets were extremely overheated at that time. And he was having a very hard time finding literally any investment. We had the Nifty 50 at the time. There was a major bull market going. And he was just having difficulty. And Warren at that time personally was worth about 25 or $30 million around then, which in today's money would be more than 200 million. And, he basically, I think when he hit that point, he was just around 40 years old, 39 years old. And he wasn't sure kind of what to do next. He knew that if he just managed the money on his own, he would do okay with that. And he didn't want to keep, at that point, his thinking was that he didn't want to keep chasing an investment rabbit for his whole life. Some of his friends thought that he would like run for president or something, which, he even says now that's just not him. And actually what happened in 1977, so it was a very easy decision for him to say, look, we've had a great run. We've made all this money for all these people. I'm not sure I want to keep doing this. I've got plenty of money on my own. So I'm going to basically disband the partnership. He already had a stake in Berkshire Hathaway, and he rolled his portion of the fund into Berkshire Hathaway. And he didn't really, there was no really any grand plan. It owned a few private companies and such, but he basically just said, okay, those look undervalued. I'll just keep it there. In 1977, when he turned 47 years old, he actually felt that his life was over. Basically, his wife, Susie, had left him. She moved to San Francisco. She wanted to end the marriage, but decided in the end, they decided they would stay married, but they would just be separated. And he felt that he had accomplished everything he set out to accomplish in investing. And he really felt like everything was done, everything was over. And he was talking about this recently, and he said that really most of the interesting things in his life happened after 77, after he was 47. And he never even thought that that would happen, So most of the interesting investments in Berkshire and all the different things that happened in his life and so on really came after that. So the partnerships being shut down was simply a function. And actually, what ended up happening is like Charlie Munger, for example, continued running his partnership and he got clobbered. The 73, 74 downturn was very intense. I mean, the stock market went down, 60, 70% over that 2-year period. It was a crash in slow motion. And Charlie ended his partnership in 74 after that huge downdraft. And amazingly, Warren Buffett being Warren Buffett, he was on the sidelines with all this cash and the markets had crashed. And in 1975, he made a quote he had a quote in 1969. He said, I feel like a sex-starved man on a deserted island. Okay. Meaning he could just find nothing to do, right? And in 1975, he makes a quote. He said, I feel like a sex-starved man in a harem. Okay, so there was such a massive change. Everything had collapsed. 75, I mean, the Dow bottomed in 81, the 75 to 81 period and through the 80s was an incredible period to be investing in. So basically, he was able to come back and with all that dry powder on the side, really kind of killed it after that.
Okay, Harvey, I think you're next.
Hi, Mohnish. Thank you so much. I'm Harvey. I'm a partner of an HBS student, and thank you so much for your talk. I wanted to go back to the issue of diversification. I was listening to a conversation that you had with Guy Spear earlier today, where you were talking about throughout the life of an investment manager, people tend to get more concentration in their portfolio as the winners become really big winners. I'm wondering if that philosophy of not constantly trimming the huge winners in your portfolio is limited in any sense. Is it relevant mostly for investment managers? Is it relevant mostly for people who are starting out and throughout the course of their life trying to build wealth through investing? Is there a point at which greater diversification makes sense? And the one thing that really stuck with me was you mentioned that the Walton family still has most of their net worth in Walmart stock. Does that still make sense if one is a new Walton coming in, not to diversify away from that. So thank you very much.
Yeah, I think that's a great question. The Davis family. So Chris Davis is on the board of Berkshire Hathaway. He replaced Bill Gates, and he's the third generation. So the grandfather Davis was an insurance actuary, and then he basically started investing in insurance companies in the 1930s, and he bought a gazillion insurance companies. And basically, insurance is a difficult business. Even though he knew it well, they were mostly mediocre to useless investments. 2% of his portfolio went into AIG when AIG was a really, really tiny insurance company in Shanghai. And one of the things that grandfather Davis did is, good, bad, or ugly, he never sold anything, just kept the entire basket. And that 98% of the basket did nothing. It was all useless. But the 2% became 95% of the pie. And AIG became, huge, north of 100 billion market cap, whatever. And the Davis family became incredibly wealthy. So, like Munger says, you only need to get rich once. And I think that if we are at a point where we don't have, we're not independently wealthy, we haven't made a lot of money, I think the approach of keeping the winners and concentrating, especially when you know the business and understand the business well, is the way to go. So, and I already mentioned, the Chinese restaurant, the Patels, they're anyway sitting with 95% of net worth in one illiquid company, right? And they're comfortable with it. They're not breaking out in hives over that. So I would be a proponent of that. Now, if the Walton family decided that, we've built all this wealth, and what if I take half of it and put it into the S&P 500 or something, for example, it's not the worst decision in the world. Pretty okay. That's a good wealth preservation rule. In the end, capitalism is very brutal. And in the end, everything goes to zero. I mean, there are no businesses that survive forever. I think the oldest business on the planet is a 700-year-old hotel in Kyoto, in Japan. And then, you start looking, and there's very few businesses that have been around for 300 or 400 years, and even been around for 150, 200 years. So durability becomes a real issue. So I am of the opinion that, I would like to keep concentrated on good businesses. The big mistake I've made in most of my career is I've sold too soon. I repeatedly sold great businesses too soon. And so, for example, this Coke bottler we own in Turkey, which actually does Coke bottling in about a dozen countries, and they also have the number one beer brand in about another dozen countries. I hope I'm smart enough to hold that for a very long time. The airport operator, I hope I hold that for a very long time. And, it's going to become a large portion of the net worth. The warehouse business already is more than 60% of one of the funds I manage. And I keep telling my investors every quarter that this is the way it is. You have discomfort, then you should do something. And so, yeah, I do think that concentration is the only way to really build wealth. And one would not fault you after you became independently wealthy if you took some chips off the table. But I would be more in the camp, if it's a great business, to keep it there.
Mr. Cash?
Yes, thank you, Mohnish, and thank you for being so generous with your time. I'm a first year here at Harvard Business School, and my question is about questions, actually, because I find that questions tend to direct your attention. So I'm curious if you have any perspective, or rather, I'll frame it like this: who in your life asks the best questions? And if you could share, what have some of those questions been that have been able to sort of direct your attention and kind of shift the way that you think about things?
Well, I mean, I think the person who asks the best questions is Charlie Munger. I think, like, for example, one of the things he says is, in the principle of inversion, he also says that you really have no business having an opinion if you cannot state the other side of that argument just as eloquently. So if you were a big fan of Trump, for example, can you also say why he's so useless? Or if you think he's useless, can you also say why he's so good? And those are hard things for humans. It's hard things for humans to keep two ideas, conflicting ideas in their head at the same time. So, I mean, I think that, rationality, like people ask Charlie, what's the one reason you've done well? He said, I'm rational. So I always find that Charlie asks the best questions. He has these great mental models. He's able to run through. I remember I would have these conversations with Charlie about kind of fork in the road issues I'd be facing with Dakshana, for example. He's never been to India. He doesn't really have, the frameworks and all that. But before I've even articulated the question, he's given the answer. And it's a perfect answer. And so just that the way that his brain works. So I think Munger runs through so many scenarios like that so well in his head. And with these, these principles of inversion and different mental models he's using. There's an essay. So there's a book, Poor Charlie's Almanac, which is a great book, I think, to read. He gave a talk at Harvard many years ago, The Psychology of Human Misjudgment. And that's an incredible talk. I try to reread that every year. But if you really understand those weird nuances of humans, it would give you a big edge, to understand kind of the quirks in the way our wiring is, because our brains are such a mishmash of ancient and modern and different weird wiring coming from evolution that it's not really wired optimally to the way we would want it to be. And so understanding those quirks can give you a big leg up. But yeah, I always find that Charlie has the best questions.
Mohnish, do you have time for one more? It looks like we have one more on the board.
Yeah, why not? Let's go.
Let's go, Tim.
Hi, Mohnish. How you doing? I just want to say thank you so much for being generous with your time. My name is Tim Kluska. I'm a first year at HBS. Appreciate the note to Vanguard for the call. I actually spent 5 years at Vanguard. Was most recently on Vanguard's manager due diligence team. My question has evolved over the course of the call, and so given your most previous response on Charlie and what you shared over the call.
Charles, the audio on that was really bad. I couldn't get the question. Did you get the question?
I caught some of it. So I think, and Tim, feel free to hop in and correct, but I think he's asking about, how do we play potentially this role of number two? So you have Warren Buffett, who leads Berkshire. He's the chairman. I think Charlie Munger is the vice chairman, but has done this incredible job of playing number two at the firm. And so how does one, play that role, do it, in a way that's exceptional? I think that.
Yeah, I mean, I think these two guys are very unusual. I find Charlie is a very strong type A personality. And I actually asked him, I said, Charlie, you have different businesses with different partners. And with all the other partners you have, you are the dominant alpha male in that relationship. And Berkshire is the only one where you are very clearly the number two. So I said, I cannot imagine you ever making a decision to be number two to anyone, right? So how does that at Berkshire, how do you, he said, why wouldn't I want to be number two to Warren Buffett? What kind of no-brainer is that? So he said, of course I want to be number two. But Warren has a quote. He said, Berkshire has been created with the architectural model created by Charlie Munger. My role has been that of a general contractor. So what Buffett is saying is that Munger basically came up with what Berkshire should be. And they actually didn't even have the framework. It evolved over time. But it was really Charlie who was kind of leading the charge. even today, Charlie's a big proponent of paying up for the better businesses. And Warren got there eventually. But a few years back, Warren made this joke at the annual meeting. They came back right from lunch, and Warren says, Charlie and I were on this airplane and it got hijacked. And, I see Charlie is very puzzled. He's looking at Warren like he's really confused. And then he says, the hijackers knew that we were loaded. And they said, we're going to make some demands of some ransom to your families. And then when they pay that money, you guys can go, right? So they made this demand for several $1 million. And Warren said that families told them, listen, these two guys are really useless. They really don't do anything all day, they just sit around. So we don't have any use for them. And we're definitely not sending any money, so you can do whatever you want. Okay. So the hijackers at this point are quite upset. They're saying, not only are we not going to get paid, we're going to lose 2 bullets in getting rid of you guys. So before we put an end to both of your lives, do you have a last wish? And Charlie raises his hand and says, I'd like to talk one more time about the virtues of investing in Costco. And Warren says, shoot me first. Okay. So, Costco, which is, Charlie was a manager forever. He tried so hard to get Warren to pay up and take a stake in Costco. And Warren just could never get that, right? And now Warren regrets it. It's been a great investment. And Charlie was on the board of Costco. He's telling him this is unbelievably great business. And so, so the second in command is a very unusual role, but it's the power of Charlie's mind that he even was able to accept that, being the alpha male that he is. And it's worked out beautifully. And it's amazing that he doesn't, Warren and Charlie say that they've disagreed many times, but they've never had an argument, which is remarkable. And Charlie's very opinionated. So even in a situation like Costco, where Warren is, clearly, he knows Warren is wrong, he just accepts that he's the boss. And I'm the helper. And of course, Warren understands that Charlie's really the architect, and he's tried to get there, but he's still not all the way there. So it's a great partnership.
All right. And Ravi, take us home.
Thank you so much for spending so much time with us today. My question is regarding private market investing. So I'm a new student for Benjamin Graham, reading up about buying small PCs at negotiated price and big public enterprise. And this summer, I was very close home to you in Houston, investing in energy services market. And I saw a lot of oil field services businesses, private ones, selling at steep discount because everybody thinks they are too toxic to touch. And the hypothesis that I developed over the summer was, why not use a lot of leverage? Not that this is a good time to get debt, but in decent markets, use leverage to buy all these private companies, which are basically $100 lying down on the ground. And do you think that's a viable plan, or this strategy is better fit only in public markets when you buy non-negotiated small parts of public companies?
Well, if you are picking up assets for pennies on the dollar, you shouldn't need to lever it, right? So, I mean, if something is 1/5 of liquidation value or, intrinsic value, then leverage isn't needed to get a great return. I think in general, it is a good idea to avoid leverage in your life. I know private equity doesn't work that way. But also I feel that maybe when you're starting out, if you were able to structure it in a kind of non-recourse way, where if things went south, your loss is limited and such, then it can work. But I would just say that if the business is that good, and in fact, it may actually cloud your judgment to think of it in a kind of levered return point of view. It may be better to think of it in a unlevered return point of view. There's a really good book that came out this year. It's called What I Learned from Darwin About Investing. written by a guy named Polak Prasad in Singapore. A really well-written book. And one of the things Polak does in his investments, he's done really well in his investments, is none of his portfolio companies have any leverage. Zero. So the fund doesn't have any leverage, but he doesn't invest in businesses that use leverage. And his logic is that a leverage business basically doesn't have optionality and freedom in a downturn. They have to play defense. And what you really want to do in a downturn is play offense. And so the businesses that have no debt, when the bad times come, they're not feeling any pressure. They're in good shape. And so in general, it's a good idea. I think that's a really good investing model to follow that. And if you have a great business, it really should not need leverage to generate great returns. So that's kind of my 2 cents on leverage.
Thank you so much.
All right.
All right. Thank you. Thank you, Mohnish. And thanks all for the great questions. So now to wrap, I've, really enjoyed organizing this event and I love how it came together, Mohnish. I'd like to do more events like this. And so as we close, I have 2 final questions. One is, who should our next guest be? And the other is, what's one question you'd want to ask that person?
Well, I think the 2 folks that I think you should try to get are the 2 lieutenants working for Warren, Ted Wexler and Todd Coombs. And to the extent that they're willing to share, you should ask them how the sausage is made. You should basically go behind the scenes. Like for example, I think Todd goes over to Buffett's house on many Saturdays and they discuss different companies and investments and so on. And Ted lives in Charlottesville, Virginia, but he, private jets on his own dime to Omaha every Monday, comes back every Thursday or something, and, spends time with Warren on different things. And so I would just say with these 2, fly on the wall, what can we learn?
All right.
And the good news is, just like you miss all the shots you don't take, there's no downside to asking them.
Right. I think that's a great next setup. So we'll see how it goes. But thank you, Mohnish. Thank you so much. And on behalf of everyone attending today, I'd like to present these gifts. Just a small token of appreciation. So there's a water bottle here, Harvard Business School. Although I know how you truly feel about Harvard Business School now, but
well, actually, you may not know this, but I'm an alum of HBS. So I didn't go through the MBA program, but I went through I spent 11 weeks on campus over 11 years. And I think after 9 years doing the Harvard YPO President Seminar, they gave me alum status. So I have something like, the same status as the HBS grad. So
yeah, it looks like you did it more efficiently though. So and then this, I don't think you're a big hat person, but I'm gonna send this.
All right, that's great. Wonderful.
It's a little HBS hat. So we'll send that over. So yeah, thank you again, Mohnish, for your time, being so generous with it. And it's been a pleasure to spend Friday afternoon with you. And thank you to everyone in the audience for your participation. I hope this was a meaningful and valuable experience for you. So thank you.